General Motors just booked more profit in the last 6 months than they did in 6 of their last 10 full years, all while actively blowing up their own electric vehicle roadmap. Welcome to Earnings Unscripted. It's July 21st, 2026, and today we're breaking down Q2 for GM.
That's really the defining paradox here. They're printing money precisely because they stopped trying to force the EV transition so fast.
Right. So the adjusted numbers look fantastic. Revenue came in around $48 billion, and adjusted earnings hit $3.57 a share. That comfortably beat the street. But on the GAAP side, net income actually tanked because they booked huge write-downs to kill off that EV capacity.
The market completely ignored the GAAP hit. The stock gapped down hard right when the earnings call started, but buyers stepped in fast and pushed it up roughly 5% by the close. And since we're talking about price action, just keep in mind our read on how Wall Street digests these prints is entirely our own opinion, not actual investment advice.
It makes sense when you see the cash they're throwing off. Adjusted automotive free cash flow surged sequentially, mostly because it's their typical spring and summer volume peak. They're still moving big, profitable gas trucks, and GM kept pricing highly disciplined.
Exactly. Inventory's holding steady around 55 days supply. They're avoiding the old trap of overproducing and dumping excess cars into rental fleets just to keep the assembly lines running. They finally learned how to manage supply, so those legacy internal combustion engines are funding the entire company right now.
Well, they certainly need the funding for this costly EV retreat, but what actually caught my eye was this massive pile of deferred software cash hiding on the balance sheet. I really want to know if that OnStar subscription money is actually turning them into a SaaS company, or if that's just a shiny distraction from the hardware drum.
It's absolutely not a distraction. The scale here is massive. They've got about $6.3 billion in deferred digital revenue just sitting there. That's mostly OnStar and Super Cruise cash, and it grew almost 50% year over year.
Wait, deferred digital revenue for our car company? I usually look for that on a Microsoft balance sheet, not a metal bender. Are they just holding on to cash for services they haven't delivered yet?
Right, exactly. When someone buys a high-end Silverado today, Super Cruise is becoming standard, but GM doesn't recognize all that cash up front. They bleed it out over the life of the subscription, so they're secretly building this highly predictable SaaS loop right under everyone's nose.
Okay, yes, but that software margin matters a lot more than just predictability. I mean, we're still talking about a heavily cyclical business at the end of the day.
Sure, but listen to how Mary Barra framed it. Quote, "Our high-margin software and services revenues continue to grow rapidly, with 1 million new subscriptions expected this year, contributing to more than $3 billion in recognized revenue." End quote. That buffers a lot of cyclical pain.
That's actually brilliant. So if nobody buys a truck next quarter, they're still collecting those subscription fees from the ones already on the road.
Exactly. But it gets weirder when you look at where else they're finding insulated revenue. You wouldn't normally check a Detroit automaker's defense segment.
I mean, vaguely. Usually defense inside an auto company is just some tiny government contract for motor pool vans, nothing that really moves the needle.
Yeah, I thought the same thing. But they've got this U.S. Army Infantry Squad vehicle, the ISV, and it's projecting some serious scale.
Right, but isn't a military vehicle just a custom-built tactical rig? Those take forever to design and actually produce.
No, that's the genius of it. It's quite literally based on the mass-market Chevrolet Colorado chassis. They aren't reinventing the wheel. The Army bought an initial 1,200 of them, and Barra said they plan to procure over 10,000 pending appropriations.
Wow. So they're taking an off-the-shelf civilian truck architecture, painting it camo, and spinning up a major military franchise?
Pretty much. And they're literally going to the moon, too. GM Defense is supplying battery tech for a lunar outpost rover that just grabbed a massive NASA contract.
Wait, that's such a wild contrast. They're powering lunar rovers in space while actively retreating from EVs here on Earth. Speaking of which, they just took another massive charge to shrink that electric ambition, didn't they?
Yep. $2.3 billion Q2 charge to finalize that reset. Mostly to shrink battery plants,
But the vital detail here is CFO Paul Jacobson claiming this, quote, substantially completes the material cash charges.
Okay, wait. Substantially completes, meaning they're actually stopping the bleeding?
Functionally, yes. But over the last 12 months, they've swallowed roughly $10.9 billion in total costs just to dramatically downsize the EV strategy and align with this muted demand.
Almost $11 billion just to admit they moved too fast? That's a brutally expensive reality check.
It's painful, but investors love the finality of it. They capped the losses, and now they're entirely focused on the internal combustion trucks that actually print money.
Which works right now, except they've got other massive structural costs looming. With all this capital pivoting back to U.S. manufacturing and the sheer scale of the gross tariffs hitting them this year, I really wonder if that onshoring penalty is going to crush this newly rediscovered profitability.
Well, that's exactly the tension right now. Management expects gross tariff impacts to land somewhere between $2.5 and $3.5 billion this year. Plus, they're pouring capital into shifting Cadillac Escalade production to the Orion plant. It's a huge upfront cost.
So they're essentially trading near-term cash for long-term supply chain security. It makes you wonder how the street models that. Are we looking at a permanent margin hit?
I don't think they see it as permanent, and honestly, the outlook suggests they're absorbing it pretty well. Even with all those commodity headwinds, they raised their adjusted EBIT guide for the year to a midpoint of $15 billion. They also raised automotive free cash flow, aiming for roughly $10.5 billion.
Wait, they raised the cash flow guide, even with $1 billion-plus drag from moving manufacturing back to the U.S.? You really have to give them credit for operating leverage there.
Definitely. But there's a big caveat for the rest of the year. The CFO explicitly warned that the fourth quarter will underperform typical seasonal patterns. They're launching the next generation Silverado and Sierra, which means heavy launch costs and a solid volume headwind.
So definitely don't model a standard end-of-year lift. It's wild, though, how much the story changed recently. 12 months ago, it was all about EV cash burn. Now they're functionally a high-margin software and defense business wrapped inside an old-school truck builder.
It's survival of the most adaptable. They swallowed their pride, capped the bad ideas, and doubled down on what works.
Not a bad playbook to follow. I think we're going to leave it right there for today. Thanks for tuning in, everybody.
Always a pleasure. See you next time.
If you're finding these breakdowns helpful, maybe make us a regular listen while you're navigating the rest of earnings season. Just a transparent heads up. This whole episode, including both of our synthetic voices, is a completely AI-generated experiment built to go from GM's live call straight to your feed the exact same day. We'd really love to hear your thoughts or any ticker requests you have, so just drop us a line at earningsunscripted@datamadness.ca.